All right, now we move on to the actual calculations under the four methods. So let's use an illustration to help us work through these. So go ahead and download your own copy of the handout for Trekking Company. All right, so this is a little more realistic of the information we'll be given. I know in the example I did in class with the 4 milk cartons, right? It was very simplistic. This one's a little more realistic. We have more units, higher value, multiple purchases, and multiple sales. All right, so we have here a company. They carry one type of mountain bike. They sell to different resorts. Customers usually purchase in units of 10 or more. Here's the data for August. They do start with a beginning inventory and they end with 12 bikes. Okay, so just some information there. And that data doesn't change regardless which method we use, right? We're going to illustrate with FIFO, LIFO, and a weighted average. Remember, those are the 4 cost flow assumptions. The fourth method, specific ID, is not an assumption. It actually tracks the exact units sold. And for that, you have to be given that information. So see right there at the information at the bottom of the table, it tells you for this August 14th sale, for the 20 bikes sold, 8 come from the 91 purchase, 12 come from 106. So they have to tell you exactly what composed this batch of sales here. 12 at 106, 8 at 91. They have to spell it out for you because it's not a cost flow assumption. Okay, now because specific ID is much more straightforward, again, they're giving you the information. And remember, we said less than 2% of companies even use it. I'm not going to illustrate that method. I'm going to focus on the first 3 more popular methods. So that being said, when you see a problem and they give you all this detailed information, that's for specific ID. Okay, so if they don't ask you for specific ID, you can disregard it. And since we're not going to illustrate with that method in this exercise, I'm going to go ahead and put a line through it so it does not confuse us. All right, so let's go ahead and start with the first method, FIFO. I'm going to show you the format I use to set up my calculations. The book has a different format. Some of the students in my in-person class, a handful, preferred that method. Go for it. Whatever helps you organize this data. You can probably even find more online. Just make sure you're searching for the perpetual inventory templates. All right, so we're being asked to calculate cost of goods sold and ending inventory, which is pretty typical because we know inventory impacts both the income statement and the balance sheet. So we're going to want to find out the costs that are appearing on both those financial statements. First, we'll illustrate with FIFO. And again, I'll show you my format. So I separate it into 2 sides so that we can calculate the cost for ending inventory and cost of goods sold. And then I scroll back up to the data, find out our sales dates, August 14th and August 31st. So those will be the 2 days that I have to calculate the sales for, right? Cost of goods sold. So we had 2 sales dates, August 14th and August 31st. On August 14th, you'll see that we sold 20 units, August 31st, 23 units. So I'm just going to put that here, 20 units, 23. Meaning when we calculate the cost, we have to make sure that we calculate enough cost for 20 units and 23 units. Okay. And then I just go up and I start that cost flow, first in, first out. So for the 20 units on August 14th, so August 14th sale would happen here. Okay, first in, first out. Your very first items that were in inventory is what you started with, beginning. You have 10. Okay, so for that sale of 20, 10 of those units come from beginning inventory, which have a cost of 91. Still need 10 more before I get to my 20. So let's go up. We can easily take those 10 from the August 3rd purchase. I'm going to take 10 units from here. And those 10 units have 106 as their cost. And you've now calculated your cost of goods sold for the first sale. Yay. All right, and if we wanted to, we could total that up, right? Usually when they say calculate the company's cost of goods sold ending inventory, they mean for the period, right? So it'll be for August. But now we know how much the cost of goods sold was for August 14th. So think back to like chapter 6, when we did this journal entry, cost of goods sold and inventory. Now we know the amount would have been $19.70. We just calculated it. AR and sales revenue, that's given to us up here under the sales section. Our August 14th, we charged a sales price of $2,600. Okay, so that's what that journal entry would look like, because I started off the chapter by saying, oh, this is going away. They're not going to give you this anymore. Nope, they're not, because we just calculated it. They just have to tell you the method, give you the data, and you can do it. All right, so we calculated the cost of our August 14th sale. We have one more sale in the month, the 31st. All right, so first in, first out. So we have our sale now, August 31st, 23 units. So first in, first out, you go all the way to the top. These units are gone though, right? But we do have 5 units left from your next earliest purchase at 106. So take those 5 at 106. 5 at 106 gives us $530. We obviously still need more units before we get to the 23 unit sale. And it looks like we need about 18 more. Okay, so these are now all gone. Luckily, we have enough to take 18 units from our August 17th purchase. And those 18 have a cost of $115 each. Or $2,070. Okay. Let's do the journal entry for August 31st. Why not? You never know what they're going to ask you. Okay, so we just solved for the cost, $2,600. Scroll up to see what was the sales price that we charged, $3,450. And it's also kind of tricky because sometimes in the problems, like in this one, they just ask you to calculate the cost and the ending inventory. So technically, we don't really need the sales price to do what they asked us to do, which was just the calculation. If they said do the journal entry, then yeah, we would need that sales price, right? So sometimes, like I said, they're going to give you extra information. We just need to filter through it and see what it is that we need. Maybe cross out what you don't need so you don't accidentally grab it. But I thought it'd be fun to illustrate the journal entry since we were used to seeing that in chapter 6. All right, so we calculated our cost of goods sold. Let's figure out what our total is for the month. Total cost of goods sold for the month. Just add it up, your $19.70 and your $2,600, and you should get $4,570, your total cost of goods sold. All right, we have one more piece to this puzzle, and that's our ending inventory. Okay, so it's to figure out what do we have left at the end of the period. Well, they told us that we have 12 units left. We just need to figure out what's the cost of those 12 units. So again, I approach it the same way. I say, this is what we need to end with, and let me gather my units and their respective costs until I get there. So August 1st, all those were gone. August 3rd units are gone. We only took 18 of the 20, so we have 2 units left. 2 at 115. Okay, so 2 units at 115 or 230. We need 10 more units before we get to our 12, and I think you can see that's all going to come from the August 28th purchase. 10 at 190 or 1190. Add it up, we get an ending inventory of 1,420. So we've answered both their questions, cost of goods sold and ending inventory. Now let me show you one check because I'm all about checks. So let's do a check to make sure we didn't mess up our math anywhere. The figure we calculated for cost of goods sold, right? The 4,570. If you add that to the figure you calculated for ending inventory, which for us was 1,420, you should get your cost of goods available. Okay, so add that up. We get 5,990. So let's go see if that is our cost of goods available. Cost of goods available is the sum of all the units you have available. Those either came from your beginning inventory or your purchases. Okay, so add that up. This is your cost of goods available. And if you add it up, you're going to see you get 5,990. So our check worked. All right, so that was FIFO. So we had to calculate cost of goods sold and ending inventory using the first in, first out cost flow assumption, which means that for our sales, all of your sales, you started with your very first purchase or items available and you just went down, right? Like in chronological order. Okay, that's the first in, first out method, not too bad. In the next video, we'll illustrate the LIFO or last in, first out method using the same data for trucking company.